Hello, everyone, and thank you for joining us today for the second session of Venable's Legal Guide to NFTs, the Metaverse, and Web3 webinar series. In today's session, we will explore the income tax consideration in the world of the NFTs and the Web3. My name is Frieda Mantoma, and I'm the co-chair of Venable's Transactional Tax Group. I am joined by Teresa Clardy, who is a counsel in our Transactional Tax Group. Today's session is eligible for CLE credit. The code for obtaining CLE credit will be given during the presentation. And feel free to also submit questions to the panelists using the Q&A function within the webinar platform. While we may not be able to answer all of your questions live during the presentation, we will be happy to follow up with answers to your questions once the webinar has concluded. So why are we talking about, this very timely issue? I probably don't have to remind the audience on the last couple days on the stock exchange what happened to Bitcoin and cryptocurrencies. I think all of the gain on some of those currencies have been wiped out over the last 1.5 years, and now we are back to a valuation which is much more closely aligned to December 2020. Obviously, crypto, virtual currency, and we certainly will get into kind of like the terminology a little bit more, has become a household name. Roughly 16% of Americans are already kind of like trading, owning some form of currency, some form of NFT, some form of functional currencies. I think it's fair to say this technology is not going away. I think it's actually probably evolving, and we will see many more iterations. But it is going to stay. And it's in the last 2 years specifically, we are seeing now much more talk about tax consequences. That in itself shouldn't be a surprise, but what is the surprising fact is compliance is extremely low. CNBC reported that Barclays kind of like estimated out about $50 billion annually are kind of like lost on the IRS, and thus there's no surprise that there's now more emphasis from the government. We suspect this figure is higher because of the evolution on crypto, especially within kind of like NFTs, and how NFTs have evolved over the last 8 months. So the IRS is looking at this issue very closely. New compliance and reporting obligations have been published very recently, and we'll see in other countries, whether it's the OECD, having similar initiatives. So very appropriately, our agenda will start on the tax enforcement of virtual currency, including NFTs. We'll have an overview and a summary and a kind of like a refresher on what limited IRS guidance has been published as of today. We are then delving into really kind of like the income tax considerations of the various digital forms of currencies, etc. We'll talk about obviously cryptocurrencies. We'll talk about DeFi's, NFTs, and DAOs. And then, if time permits, we'll talk about some ancillary but equally important tax considerations. So I will gonna hand it over to my colleague Teresa to talk about the tax enforcement.
Hi, everyone. So the IRS is really cracking down on taxpayers in this space. They realize they are losing a lot of revenue. And this very much feels like when the IRS went after people who had offshore accounts. The resources they are dedicating to this is significant. They have working groups, they have educated staff, they have new departments. I'm not going to go through all the departments or working groups. They have what's called Operation Hidden Treasure. Again, they're looking for revenue, but that's a team focused on taxpayers who emit income from crypto. They are coordinating with the DOJ on the criminal side of things. They have touted that they're going to make more criminal referrals if they smell something that looks like tax fraud or tax evasion. And significant cases that have a whiff of tax fraud or tax evasion will be assigned an IRS criminal investigation special agent. But kind of the more interesting things that have taken place recently is the IRS has issued what's called a John Doe summons to some of the big cryptocurrency exchanges to get information about their account holders and those purchasing cryptocurrency. And in 2016, they provided Coinbase with a John Doe summons and said, give us all of your account holders for various years. There was no limitation. So they went back and forth in the courts, but the court ultimately granted the request with some limiting factors. And then roughly a year or two after there was that production, a bunch of taxpayers started getting warning letters from the IRS saying, we suspect that you have virtual currency transactions that have not been reported. I think they sent out about 10,000 of those warning letters. And, it looks like they are using the data that they're getting from these John Doe summonses to target taxpayers for audit. Also, too, in 2021, federal courts authorized the IRS to issue 2 more John Doe summonses to Circle Internet Financial and Pay Forward Ventures. So I suspect we will see a new round of warning letters being sent to their customers in the next year. The other thing I think is very interesting, the IRS is touting, I've heard it a couple times and they've published it, that they're using increased data analytics. Now, I haven't known the IRS to be up on technological advances, but it seems that they have made strides to use better technology to do their jobs more efficiently and to discover taxpayer data. So the fact that they're publicizing this means they probably did, update some of their technology, although query-wise still send faxes to IRS agents I'm working with. But, it is something to note, and they're definitely focused on this area. So this is more of the similar vein, the IRS is been given tools to help them with enforcement. These tools include new audit questions, new training of auditors. They're going to be asking for wallet information. And then also to Congress in the recent 2021 legislation on infrastructure extended reporting requirements on the 1099-B and the 8300 to extend to certain digital asset transactions. So the IRS is going to expect more compliance and more reporting to better identify those taxpayers who are not reporting their income from virtual currency transactions. And included in all of this, one of their biggest new tools is this question on the 1040. It came about in 2020. This is a copy of the 2021 question. And it basically asks, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? Now, I read that statement, and as a lawyer, I think that's very, very broad. It could encompass a whole host of transactions that are taxable and non-taxable. But the IRS tries in the instructions to clarify what it means by virtual currency and what type of transactions trigger reporting on that question, require yes on the question. So in terms of the definition of virtual currency, again, it's defined very broadly. I've highlighted it here. It's a digital representation of value other than a representation of the US dollar or foreign currency that functions as a unit of account, a store of value, or a medium of exchange. So that's a pretty broad definition. It definitely encompasses cryptocurrency. It could be construed to encompass NFTs as well, because NFTs are sold, bought and sold, so they're a medium of exchange. So that raises the question, if you have an NFT or if you have crypto, what are the types of transactions that require you to check yes on that 1040 question? And big picture, I think a lot of this is pretty obvious. If you receive virtual currency in consideration for services, that's a taxable transaction. You have to check the box. Receipt of virtual currency, they're all getting at taxable transactions. Receipt of virtual currency as a result of mining, exchanging virtual currency for property, goods, or services. And then, I'm not going to read them all. You can read the instructions at your leisure. But the last bullet is incredibly broad. Any other disposition of a financial interest in virtual currency. What does that mean? There's not a lot of clarity. Does it mean a partnership interest that holds virtual currency if you dispose of that partnership interest? How broadly are they going to interpret it? On the rest of the instructions, it does clarify a few things, although it doesn't provide total clarity. In the first sentence, it talks about if you transfer property or transfer virtual currency in one wallet to another wallet that you hold, that's not a taxable transaction. It also makes clear that if you purchase crypto for US dollars, that does not require you to check yes on the virtual currency question. So to me, what this clarifies is they're really going after taxable transactions. It's not just a purchase, which usually doesn't result in any tax if you purchase with US dollars. But for example, if you purchase NFTs with crypto, there are going to be taxable transactions associated with that exchange, and that would require you to check box yes. So, the general rule that I'm looking at is, if it's a taxable transaction and you're reporting it anyway, err on the side of caution and check yes to that box. It never hurts to disclose something that you're doing. It just makes you look like you're trying your best to do what's required. I briefly touched on the new tools and the reporting forms the IRS is using in the near future to catch more people who are not reporting their virtual currency gains and income. The first bullet, I note W-2s, 1099-Ks, 1099 miscellaneous. These are all forms that have always been in effect if you receive payment of virtual currency in exchange for services or other types of transactions. So these are the forms that exist that could come into play on virtual currency transactions. Again, for example, you provide services in exchange for crypto. There will be W-2 withholding and reporting. And so those rules still are in play. The new rules are the 1099-B and the Form 8300. The 1099-B is what brokers are required to provide and file with the IRS, showing sales, primarily sales and other transactions involving crypto that have tax consequences. So, I buy and sell my stock, I get a 1099-B at the end of the year showing what my sales price is, what my likely basis is, and all of that information that I need to correctly report it on my return. Even if I don't get a 1099-B, it doesn't mean I'm not taxable. So people should be aware and take note of all of their sales of crypto, NFTs, interests in entities with crypto or NFTs, because just because you don't get that form doesn't mean you don't have an obligation. And then the Form 8300 is for people who receive 10,000 or more in digital assets in a transaction, or multiple transactions. So basically you get $10,000 in a transaction that involves, your business, you have an obligation to file that form. And the additional wrinkle is the OECD crypto asset reporting framework. So the US does not follow the OECD. We do our own thing. But the countries that do follow the OECD will likely follow the crypto asset reporting framework. And basically this is threefold. It's providing draft legislation for countries to adopt so that there are new reporting standards in those countries capturing digital asset transactions. Second, it provides proposed modifications or proposed language to treaties so that countries can adopt these revised treaty provisions, and it facilitates the exchange of information between countries. So, OECD country one gets information from their citizens and what's required to be reported. If they have an exchange of information agreement with country two, then they can also provide that information to country two with respect to their residents and other parties.
Teresa, I think it's a very important point for the audience to note that even though, as you pointed out, the CARF is yet to be enacted and there is consultation period that happened in May, there is a plan to present kind of like a comprehensive reporting scheme that is going to be parallel to the CRS, to the Common Reporting Standards, as in October of this year. And even though the OECD, the US is often kind of like not following one by one any of the OECD guidelines, I think it's going to be extremely instructive and important to follow to understand what the OECD and how the OECD goes about those recommendations. And we'll get, I think, much more clarity at the end of this year. And there is quite a bit of concern that because of the crypto and digitalization of financial transaction, that basically there is a non-compliance on the CRS. And so we should expect very much pretty stringent rules to get back to what the OECD was kind of like meant to accomplish.
That's a great point, Friedemann. All of this to say, why are we talking about tax enforcement? This is just to show you that the gap for not reporting is going to be narrowed, and the IRS is going to make it expensive if you don't report and pay your taxes with respect to crypto. The time for hiding income and gains through these types of transactions or not reporting it is coming to an end quickly. The IRS thinks that there's a ton of fraud in this area. I don't necessarily know that that's true. I think a lot of people don't know that some of these transactions are taxable, and just, a lack of knowledge. And that is, one of the reasons I think tax compliance is so low in this area. But just to give a quick synopsis of the statute of limitations and penalties and interest, I put willful tax violation on here. Basically, that's if you intentionally know you have an obligation to file and report income, and you knowingly try to hide income and not report the correct amount. That's what's called a willful violation. The other, what I refer to as a non-willful tax violation, is basically a foot fault. You didn't know, or it was an accident. You didn't realize that you didn't report all your income. In big picture, in terms of the civil statute of limitations and civil penalties for willful tax violation, where this comes up is usually after somebody has been criminally prosecuted or comes to some sort of plea agreement with the government on the criminal front. So normally if they smell something's not right in terms of tax evasion or avoidance, they'll refer it to be investigated criminally. If that results in a successful prosecution, or if there's some sort of plea agreement, then they'll turn to those individuals civilly. And because for willful tax violations, the statute of limitations does not expire, they can go after the missing taxes and impose penalties after that, and they're not barred by the statute of limitations. Mostly what we see is the IRS using either the 3-year or the 6-year statute of limitations. Those statutes begin to run from the due date of your return or the extended due date if it's on extension. But if you don't file your return by then it's the later of when you file your return. So that's when the clock starts running. There's a 6-year statute for substantial omissions, but normally the general statute is 3 years. California gives an extra year. California has 4 years. And California also has a 6-year statute of limitations for substantial omissions, similar to the federal government. So the IRS and the FTB here in California, they'll have several years to catch up, get data, and be able to audit and assess taxes that are missing. If they do, they can assert penalties. Normally, if you file a return and you're missing something, you typically see a 20% penalty unless you have a defense based on reasonable cause or something else. So usually it's a 20% penalty unless you have a good defense to the penalty plus interest. And right now, the interest accrues at about 5%. It's the short-term AFR rate plus 3%. So right now, any unpaid taxes, the interest is 5%. So that goes back to another tool the IRS is using is questions and audit, requesting disclosure of wallets, wallet IDs, blockchain addresses. Generally, just taking a step back here, all taxpayers have an obligation to keep records to support the positions taken on their returns. And generally, taxpayers have the burden of proof. So it's important, if you're engaging in these types of transactions, to do your best to maintain the records, because audit's not going to come for a while, and maintain sufficient information so that you can support the positions you're taking on your return. The IRS FAQs, we're not going to talk about the specific identification method yet. Friedman will touch on it when he goes through the current IRS guidance, but they did give some recommendations on documentation you should keep, to prove what method you're using. Here's what's really complicated is they want you to keep a record of what is fair market value. And as Friedman mentioned, the market right now is so volatile. So that raises a lot of questions on how do you determine fair market value. Now, the IRS guidance says you determine it when the transaction occurs, but that is very hard to do. And Friedman, you've had some experience with this. What is your general thoughts on determining fair market value in this area?
Yeah, so I think there needs to be a little bit of a distinction between the various instruments, whether they are security tokens, whether they are kind of like utility tokens, whether they're cryptocurrencies, whether the cryptocurrencies like Bitcoin are traded on an exchange or not traded on an exchange. And I think all of those types of instrument will actually have a different approach from a valuation perspective, which obviously is utmost critical for purposes of determining what either your tax base is or what your taxable income will be. I think very briefly on the securities token, kind of like the typical ICOs, initial coin offerings, I think there's quite a bit of clarity what a fair market value is, because there's a trading price, a corresponding trading price. But I think in the space of the utility tokens, kind of like the MAC, that's where most of the conversation is happening from a valuation perspective. And obviously, we have the traditional valuation methodologies that we can think about, whether it's the kind of like the market approach that I mentioned before on the security token, whether you kind of like go into some form of income approach or some form of cost approach. And I think that's kind of like a new thing, that way you kind of like go into the so-called quantitative theory of money, which is a complicated theory to kind of like model to understand what a defendable position might be for the IRS. So I think when the IRS talks about fair market value, especially in the space, which I also think that's where most taxpayers are located, in a utility token, that's where there is a real art for purposes of determining a fair market value.
Great. Thank you, Friedman. We did get a question from the audience. They asked, is there a minimum amount in purchasing crypto that requires reporting? So it depends what you purchase the crypto with. If you purchase crypto with other crypto, that would be considered a taxable exchange, and there's no minimum amount that requires reporting. If you do that, whether it's for $1 or $100, you need to report it. Now, if you just purchase crypto with US dollars, then it's clear from the instructions that you don't need to check the box. Also, that wouldn't be a taxable transaction. It's not until you later sell the crypto or exchange it for other property that taxes and the tax consequences would arise. So moving to the next slide. Irs guidance. Friedman, take it away.
Yeah, so there is some limited but useful Irs guidance that we have been the benefit of. It has, obviously notice 2014-21 with combined with the FAQs gives us a kind of like a touch point. And it's interesting. The 2014 notice talks about a convertible virtual currency. It doesn't actually talk about, all of the various currencies that we are talking about these days, and understandably, but it basically makes a very broad statement, and that's very important. Convertible virtual currency is property, and it's not a foreign currency. And that kind of like has a fundamental change in the way how we think about kind of like a digital currency. In terms of kind of like just the terminology, I think it's also important to remember people will, and taxpayers and even practitioners, utilize that virtual currency. They will talk about cryptocurrency, digital currency, the payment tokens. I think we have a less so these days, but there was a lot of talk about stable coins. I mentioned before utility tokens, security tokens, which are kind of like more in the space of the ICOs, and then of course why we are all here is kind of like NFTs. I think there is a big discussion about what actually the right characterization is, and so far the guidance that the IRS has given us is basically saying it's all a property. I think there is much to be desired about this, and there could be lots of arguments, and we should, and I think the various initiatives are happening within taxpayer organizations to really think about whether, for example, a virtual currency that is property could also be characterized as a commodities, right? I mean, that's one area where people are thinking about. And why is that relevant? Well, it is relevant because commodities that are kind of like, for example, traded in the commodities future trading platform, they are benefiting from some certain tax rules, such as that they, you can trade with them without actually having, taxable income if you're, a person who wants to get access to the capital markets from outside of the United States. Very similar to kind of like what you have with the securities and trading in the safe harbor for purposes of the 864 safe harbor. So it could be, as I said, a security, but for now, the kind of like the general principle apply when you look at an NFT transaction or a virtual currency. You're dealing with property.
Right. And just to that point, in the code, sometimes they define security very broadly based on the SEC definition. And in that case, potentially crypto and NFTs are securities. But in other areas of the code, they define it much more narrowly, where these type of assets wouldn't fit the definition. So they wouldn't get the same tax treatment that apply to to securities in the tax code. So it's interesting because there isn't this one size fits all. There's a lot of uncertainty, and it's kind of unfair that the IRS has given sparse guidance, but they want taxpayers to report everything and report everything correctly. So basically the IRS has punted to tax professionals for us to figure it all out.
So the IRS also brought out a few new rules which are helpful insofar of clarity. So there was a revenue ruling in 2019 that basically talked about the hard fork, and really what this is all about is you have a token on the blockchain, and then there is basically a disagreement in terms of the way how to continue with the blockchain, and then there is a fork which basically divides the blockchain into two new blockchains. And so there was a big conversation about whether that is a taxable event or not. And basically the IRS came out in 2019 to state, as long as the recipient of these tokens has dominion and control over the new tokens, then that is a taxable event. Maybe not the answer that the taxpayer wanted, but it gives the clarity. In terms of further advice, there's a CCA with regard to kind of like receipt of digital currencies and tokens and NFTs that basically say the receipt of any of those in connection with providing services will be a taxable event. It's basically almost like some sort of bartering event, and it's also likely subject to self-employment tax. And then lastly, also not very surprising, but kind of like at least clarifying, there's no 1031 exchange for crypto. And again, it makes sense because it's a property for property exchange, and they are not seeing that as a like kind exchange, and therefore any types of exchange will be a taxable event to the taxpayer.
And just to clarify, since the taxpayer, I think it was the Tax Cuts and Jobs Act enacted during the Trump administration, like-kind exchanges don't apply to real anything other than real property going forward. And so what this Chief Counsel Advice Memorandum did was it looked at whether the law prior to the TCJA would potentially apply. And where this is relevant is that, for example, California has the pre-TCJA rules on like-kind exchanges, but this revenue ruling really dismantles the argument that you could have a tax-free exchange under those prior rules.
So yeah, that's a very helpful slide. Thanks, Teresa. So in terms of for tax professional, this is kind of like a list of questions and issues, kind of like an issue spotting list that everyone should always have in their back pockets to really walk through every single time there's some form of transaction with NFTs or cryptos. The first one is always a very important one. Is it kind of like business? Is it business activity? Is it for investment, or is it for personal use? And obviously, if it's for personal use, that limits the deductibility in terms of kind of like no basis deduction. In terms of kind of like whether it's business or investment, it very much then derives, and it will dictate on how taxability is calculated, whether it's on gain or ordinary. We'll get to that, but it's also important to understand how crypto or NFTs are held. And the reason for that is it has lots of implications, not only from a taxability perspective, but also from a reporting perspective. Obviously, the next question is an obvious one. It's always important to think about the character as well as the source, because it has, different rates come into play. as Teresa mentioned before, when you kind of like buy currency, crypto for another crypto, when is the event of taxability realization event? I touched on the value, and I think there's a lot more to be explored because I think taxpayers are getting more savvy. And then obviously your basis analysis, FIFO, first in, first out. And then whether you have a deductibility, whether the losses are deductible. And again, that leads back into kind of like whether something is personal or investment. And then about the rate, we'll talk about a little bit whether, especially in the NFT space, whether something can be characterized as a collectible piece of art, etc., whether then you have different rates that apply. And then lastly, and not to forget, is many times, especially because crypto is very global, not only income tax considerations apply, but many times also direct and indirect taxes. And then lastly, of course, as I mentioned, kind of like the reporting requirements by themselves can be very onerous. And we see this a lot in terms of when we have kind of like PE types of arrangement where crypto is held through some form of platforms or some DeFi arrangements where people don't think about it. I also wanted to quickly, before Teresa kicks it up on the cryptocurrency, give the audience the CLE code. It is digital 2022. Digital 2022.
Thanks, Friedman. So I'm just going to touch briefly on cryptocurrency. With the notice and the Irs guidance, they really focus a lot on crypto type transactions. I'm just going to lay out the basics just because cryptocurrency is used in transactions to buy and sell NFTs. So just understanding, since it's not a tax-free exchange when you use crypto to purchase an NFT, what are the tax considerations you should be thinking about? So, when you sell crypto for other crypto, that's a taxable exchange. When you sell crypto for US dollars, that's a taxable transaction. When you sell crypto or use crypto to purchase an NFT, that's also a taxable transaction. And the character of that income as ordinary or capital gain really depends on whether the asset is a capital asset in the hands of the taxpayer. When you have an initial sale of crypto, oftentimes it's ordinary income for the issuer because they're selling a bunch of coins. It's part of their business. It's basically like inventory. So it would be ordinary income for the issuer. On a subsequent sale, say I buy and sell crypto, the character typically would be capital gain. I'm typically either doing it for personal reasons, more likely for investment reasons, and that would receive capital gain treatment. The amount of my gain would be the extent the fair market value of the property I receive or the cash amount exceeds my basis in the property. So generally my basis is what I paid for to get the property, or if I'm doing an exchange, it's the amount I was taxed on. So that's typically my basis in the property. Now we'll discuss FIFO and specific identification method later. If you can specifically identify which asset you're buying and selling, you can use that purchase price, that cost basis as your basis. If you can't, if you're buying a bunch of Bitcoin and you can't distinguish which ones you're buying and selling, the Irs guidance says you have to use FIFO method. If you receive currency for services, that's income. That's like employment income. It is employment income or it's self-employment income because you are receiving crypto in exchange for services. Or in a lending type situation, if you receive interest, that's ordinary income. Exchange of cryptocurrency, similar to sale of cryptocurrency, it's typically capital gain for a subsequent sale by an investor or somebody dabbling in this for personal reasons. I'm going to skip through some of the examples just because we really want to focus on NFTs, DeFi, and DAOs. I think one of the key takeaways is, we have an example on somebody losing their wallet and whether or not it's deductible. What's very interesting is in the forms dealing with theft and casualty losses, it makes clear that just simply losing property or losing money doesn't result in a casualty for purposes of the tax deduction. So query whether, there's potentially an abandonment or some other basis to take a loss. But losing a wallet or the keys to a wallet raises a whole host of complex issues because it's not a theft. The IRS takes the position it's not a casualty. So there's a question whether you're able to deduct the losses. Friedemann, do you want to touch on example 3 or should we skip straight to NFTs?
I like to go to the decentralized finance.
Oh, yep.
That's a wonderful topic, and it's an interesting topic, and it's actually quite timely. So the DeFi or decentralized financing. I mean, it's really this exploded. Just to give you guys some numbers, where we're looking at kind of like the volume of digital asset loans in 2021 was more than $130 billion. So this was a kind of like a nearly a 6-fold increase over digital asset lending volume in 2020. So the DeFi is here to stay, and it's quite powerful. So why are people doing crypto lending? It's a non-traditional source of financing. Trades may borrow crypto to short it. I hope some people did that. They definitely made a killing. And then the retail investors may lend their crypto to earn a fixed income. So there are many reasons, many financial reasons why to do that. So as of today, there is no industry standards for documentation for digital loan assets. The way how many digital asset loans are made are basically through those DeFi arrangements. And I think the colloquial term smart contract is kind of like what probably most people have heard about. And that's kind of like what this is kind of like allowing to do. So here's kind of like the interesting part about this. So the section 1058A will allow a loan to have no gain or loss on a loan like that, as long as it is a security, and the security needs to meet certain requirements. The lender needs to have receive identical securities at the date of maturity. The lender will receive subsequent payment, and the loan does not reduce the lender's risk of loss or opportunity for gain. So the IRS has very stringent rules out there, but it only applies to securities. And as we indicated before, crypto does not qualify as a security. And so, the question becomes for folks to do when you're analyzing these arrangements, is there kind of like an equivalent analysis that can be done and some similar principles? It's interesting, the legislative history of 1058 indicates that the rules actually are embedding some authority, some case law of previous cases that kind of like could extend into the crypto, meaning even though crypto isn't a security, it should kind of like there should be an analogy. Obviously, the IRS hasn't provided any guidance, but interesting enough, the Green Book this year proposed basically to extend the 1058 rule that apply to security also to digital assets. So I expect and hope that we'll get much more guidance on the DeFi for purpose of the lending and the borrowing.
And I think that one of the things when you're looking at all of these arrangements, you have to understand the rights and the details, because no one's situation is the same. So if you have a situation where somebody contributes their crypto to a DeFi company, and that DeFi company then invests that crypto and query whether they're going to get their identical crypto back. Is it considered a token for token exchange? Are they exchanging it for a token in the DeFi organization? You know, I think it depends on the facts and circumstances. You know, if you know, whether the benefits and burdens of ownership have changed, are they going to get their identical crypto back? Does the custodian, the DeFi company, can they sell the crypto? Do they have the right to transfer it to somebody else? All important questions to ask when you're looking at these arrangements and determining whether they're taxable in the context of, you know, even in the context of wrapping, which, you know, falls sometimes into the DeFi arrangements and sometimes not. So,
and I think the wrapping is an interesting, and we are getting lots of questions on wrapping. So what is basically wrapping? Is you can kind of like take one cryptocurrency, wrap it, so to speak, and put it on a different blockchain. That's kind of like what wrapping is. And it's kind of like, and I think Bitcoin was one of the first. So, you know, you couldn't take a Bitcoin, cannot be really used on the Ethereum blockchain. So that just doesn't kind of like, that doesn't work. And so what people have done, they're kind of like, they take a Bitcoin, they've wrapped it into a WBTC, and then an ERC token, Ethereum token, is that now compatible to be traded on the Ethereum blockchain. So in a way, it's just a methodology of making it easier to transact within the universe. We are getting lots of questions because the exchanges are usually viewing a wrapping exercise as a taxable event, and it may be a shortcut, and it may be easier to issue a 1099-B. But the two key elements for purposes of analyzing whether a wrapping is really a taxable event is, number one, do the benefits and burden of the ownership change? That's the key element. And does the custodian have the right to transfer the crypto to another person? Those are the two critical exercises in terms of a wrapping analysis to determine. And I think the conversation that we actually see with our clients is very much with the custodian and the person who's ultimately issuing the 1099 to determine whether or not it's a taxable event or not.
All right, so we're gonna go on to NFTs. We could probably spend the whole hour just talking about DeFis or any one of these topics, and I know we're ambitious to try to cover a lot in this session. But NFTs, I think we're all aware of the definition. They're non-fungible units of data stored on a blockchain that form a digital ledger that can be sold and traded. What makes NFTs interesting is that it's not just art. Usually they're offering some sort of experience or gaming activity or membership to a social club. So when they're tied with this kind of personal benefit, it makes it much more complicated to analyze from a tax perspective, because whether or not you have losses or deductibility of expenses does depend on whether it's for personal purposes, investment purposes, or business purposes.
So Teresa, I think that's a really key element, right? So I think sometimes people talk about NFTs as being a category of a digital asset, but what you are really pointing out here is an NFT isn't really a category. It's an umbrella in its own right. And so a NFT may be a representation of art. An NFT may be actually a tool, a gaming tool. Mm-hmm. An NFT may be an experience. And depending on those types of the purpose of the NFT, the taxability analysis changes.
Definitely. And you know, I'm not going to go through all of the uses, but there are various uses. They sometimes are access to concerts, other sort of personal experiences. So we're just going to go through the basics on NFT tax consequences. The tax consequences for the issuer, the person minting it, the creator who then sells all of the NFTs. Once they create it, that's not taxable. It's not until they monetize the NFT that you have taxation or potentially a tax event. But there are a lot of questions because no one NFT seems to be identical. You have to ask, what does the token represent? In the case of DAOs, which hopefully we'll touch on briefly, we have it towards the end of our presentation. They're using organizations to invest in NFTs or other organizations. So if the token has rights to ownership or voting rights, that creates a question on whether they're getting simply intangible property or an equity interest in what could be a business entity for tax purposes. So you have to go through the analysis on what does the token represent? Is it debt, equity, neither? And if it's just intangible property, is there a sale? Is there a license or is it services income? So what does the monetization event represent? If you're getting property for money or other consideration and all the benefits and burdens of ownership change, that's a sale, generally speaking. If it's just access for a limited period of time, it could be a license. And the tax treatment of a sale versus a license is different. One gets capital gain treatment, one can get ordinary income treatment, and same with services. Is it really a service that's being provided like streaming content or other things? And then is the issuer foreign or domestic? Again, we won't touch too much on the issues, but we're just mentioning it so you can issue spot that it does matter whether in certain cases the issuer is foreign or domestic. It definitely matters for the issuer's own tax consequences, and it could have implications for the person purchasing the asset.
Teresa, one nuance is worthwhile to point out if you may go back to slide to 33. So when an initial sale of an NFT is done, that needs to be obviously analyzed, whether it's a sale transaction, whether it's a license transaction. But as we know, these NFTs are many times then on-sold, so this is a secondary sale. And many times the creator of the NFT retains a residual interest, not only at the initial sale of the NFT, but then also with any subsequent sale, the creator may retain a residual right. And therefore you could have a bifurcation and a different treatment for the initial sale, where it might be a sales transaction, i.e. capital gain. Then the secondary sale may be a bifurcation between another capital gains transaction from the person who acquired the initial NFT, but the underlying recipient, that the creator might get some form of royalty, and therefore it's more akin to a license. And that's kind of like where also kind of like the withholding tax complications and implications come in.
Yeah, definitely. And this next slide just illustrates that, a lot of times, when we're seeing these transactions, it is a sale, but I note that sometimes it has a license or service component, as Friedman illustrated in his nice little example, that has a separate tax treatment. So you really have to understand what you have here, what the rights are, to analyze it correctly. So the tax consequences for the purchaser, generally purchasing it with US dollars doesn't result in a tax event, but if you do purchase an NFT with crypto, you have a sale or exchange of the crypto, and that's a tax event on the crypto side. Your basis in your NFT is equal to your purchase price in US dollars or the fair market value of the property you use to purchase the NFT. And then Friedman for subsequent sellers.
Yeah, I want to especially kind of like focus on the notion that, and there was a lots of conversations about whether an NFT could be a collectible. So the IRS is very clear that when you purchase a piece of art, when you buy a Monet or a Van Gogh, and you sell that piece of art, then it is a so-called collectible. And then it has a very, very specific tax regime that applies to collectible with a maximum tax rate on gain up to 28% instead of the 20% tax liability. Obviously, an NFT is, some NFTs are pieces of art, but then it goes into the statutory interpretation of that provision within the code, which we set out here, which is the 408 M2 provision. And I think there are two readings of that provision. You can either read it as in any piece of art, whether it is tangible or non-tangible, is subject to that rule. Or when you read it, you can say it is a piece of art as well as all kind of like other category or any other tangible property. And of course, if you take the or to qualify that a piece of art needs to be tangible, then you may argue that an NFT, even though it's a piece of art, is not subject to the to the 408 rules, and therefore it is kind of like would be subject to the capital gains rate at 20%. One way what I have seen some clients to do, they basically, because the 28% rate is only applicable if you're kind of like in the maximum tax rate, so that does at the lower tax rate might apply, you may consider doing some form of installment sale where you sell a NFT that may be a piece of art in 1 year, at the end of the art, you make an installment in 1 year and then the second installment the second year, and therefore you may be able to kind of like reduce the 28%, just kind of like a planning opportunity. With regard to the NIT, we have seen lots of questions, and we're getting lots of questions. I think it's pretty clear the NIT applies to NFTs.
So I don't think we're going to get to DAOs. I think we'll finish up NFTs and then just quickly touch on the tax issues and tax considerations with DAO just to take full circle. But I know losses are front and center to everyone's thought process right now, seeing the volatility in the cryptocurrency market. Losses have, so somebody has emailed that they don't have the CLE code, but we'll get to that at the end. So losses depend, the deductibility depends on whether it's for investment purposes, personal hobby, or business purposes. And, for investment, you can still deduct investment losses against your capital gains and an additional $3,000 against your income. Personal hobby losses are not deductible. Business losses are deductible, but subject to other limitations. So it's very important to understand what the taxpayer's motivation is and the background facts in holding this asset to analyze the deductibility of losses correctly from a tax perspective.
Yeah, and Teresa, last point on this, the hobby versus personal. I think we are seeing lots of questions coming up on the NFT space for NFTs that are now being in the gaming industry. And there's this real question, well, is that just you're buying an NFT to game with it, to get an experience, or is it actually for investment purposes? So I think this is also an evolving a conversation. You're 100% right, especially given what's happening in the marketplace. It's an absolutely critical determination whether something is for investment or hobby.
And we had an example, and we're not going to be able to get to it, on Seth Green, who lost his NFTs through theft, and he was working on a business project using it. A whole host of tax consequences associated with it. Obviously, PE funds involving NFTs have a whole host of tax considerations. We just want to touch briefly on DAOs and what they are. Basically, they are, people have equated it to a chat room with a bank account, but basically it's using the blockchain to obtain some form of group membership where you have rights and interests with respect to the assets held by the DAO. So this starts to look like a business entity for tax purposes. There are different kinds of DAOs, and I think the use of DAOs are still evolving. It's very important when you have a DAO to analyze whether it is a business entity for tax purposes. Is it domestic or foreign? Is it a partnership or a corporation? There are certain default rules that you have to look at. And, there's a whole host, and Friedman could speak another webinar on all of the foreign implications if your DAO is a foreign business entity. And so these are just some of the key things to look at when you're looking at DAOs and your clients who invest in DAOs, or if you're investing in DAOs. And since we have a couple more, we're running out of time. Friedman, any last comments on DAOs? Because we are at the end.
I think we appreciate the audience to have sticked with us for the 60 minutes. Let me read one more time the CLE code, which is Digital 2022. And we really appreciate and thank you for joining for today's discussion. We'll make a recording available shortly on our website. And then, of course, we hope that you will be joining our last webinar on our symposium series taking place tomorrow on June 16, as partners from us on the advertisement team discuss how to stay legally compliant with running NFT price promotions and other consumer protection considerations. So to learn more about us, or if you have any questions related to today's topic, please do not hesitate to reach out to one of us. And thank you again for spending time with us.
Thank you all.